Greetings, ladies and gentlemen, and welcome to this month's edition of the Global Masterclass. My name is Nkosana Nzima, and I'm a global fund specialist representing Momentum Global Investment to the South African market. And I am standing in for Natalie Harrison, who will be back with us for the next session. Very excited for this session as we have our investment director, Andrew Hardy, and Andrew leads the broader Momentum Global Investment Management investment team, and also a portfolio manager for our Momentum Global Equity Fund. Also on the call, we have a very familiar face on this platform. We have Robert White, who is also a co-portfolio manager along with Andrew Hardy on the Momentum Global Equity Fund, and also a portfolio manager on our managed solutions. So just to quickly run down the agenda items. So we'll start with Rob, who will give us a quick market update. Quite a lot has happened on the market, so it should be interesting to hear what Rob has to say. He'll also answer some of the questions that would have been sent prior to the session. Then Rob will hand over to Andrew, who will just speak to us on diversification. Diversification has come under the spotlight with recent market events, so it should be interesting to hear from an expert what he has to say. Then at the end of the session, we'll have a question and answer session. So please do post any questions that you have on the chat functionality, on the question functionality, and I will narrate those questions to either Andrew or Rob. So with that said, I'll hand over to Rob, who will do the first session on the market update. Thanks, Rob.
Thank you, Nkosana. And just bear with me whilst I share my slide deck. Obviously, a interesting time for markets at the moment, and particularly here in the UK, where the breaking news, if you've not heard it yet, is that our Prime Minister Liz Truss has resigned. And I have perhaps somewhat appropriately titled my section as Anarchy in the UK, which people who follow, 70s punk might appreciate that title. But again, I'll talk through I'll start with what's happening in the UK markets and talk through the broader implications and what that means for global markets, and do a kind of round trip of what's driving macro or macroeconomics at the moment. So hopefully you can all see that, and it's nice and full screen. And so I'll kick off straight away. And I thought it'd be interesting to start with this graphic, which again, very good heading, very good picture there from the New European, which I particularly like. But while we do our best to avoid home bias here at MGym in London, it has been difficult to do that in recent weeks, as the UK market has been front and center in the financial press. Of course, Liz Truss has just resigned, but we've had the whole debacle of the ironically named, presumably, mini budget from Kwasi Kwarteng, who is our ex-chancellor that's shown on the right. And the new chancellor on the bottom left is Jeremy Hunt, and he has basically reversed all of these measures in the mini budget, with the exception of a couple. And so far, that's calmed markets, and it looks like Liz Truss's resignation has been pretty much predicted by all commentators and markets as well. So it looks like the big moves for now have already come through, but of course volatility is still out there. So really, I think the political situation is still a bit of a mess, but warnings can be learned from the financial situation. I'll talk to some of these throughout this presentation. So just to outline the proposals of the kind of now defunct budget. Initially, the plan introduced about 160 billion of unfunded tax cuts over 5 years, and that was on top of an energy price subsidy, which effectively, it froze energy prices. So the spending would have been uncertain, but it was projected to cost about 60 billion sterling over 6 months, and that all comes after the Exchequer spent about 370 billion or so through COVID support measures for businesses and households. So that's building up a lot of debt at a time when rates are rising, and of course it's caused some concerns in the marketplace. So Liz Truss, when she introduced this plan, she was betting on growth to overcome these obstacles, and so we could grow our way out of debt. But of course, this whole kind of trickle down argument that's shown on the right, that's been doubted by a lot of major economists, and you've had all sorts of economists in the US and the IMF and so forth come out against that policy. And the reason really is because the economy looks like it's running at full capacity, and the danger of a big fiscal stimulus like this is that you just trigger inflation. And that's at a time right now when our latest inflation print is 10.1%. And of course, those large inflation prints are less common in developed markets, but they can be equally harmful, as plenty of people are seeing at the moment in terms of the increasing costs for everything at the moment. So, of course, there was this chaos in the government bond market, or UK gilts as they're known, and you can see these dramatic spikes here on the right-hand side. So we had some of our biggest daily moves in the 30-year, on consecutive days. So the biggest one being that 100 bip move down from 5% to 4%, which happened after the Bank of England moved in. But this sorts of volatility is pretty unheard of in what should be relatively boring gilt markets. But of course, it's becoming a function of what's happening with rates globally. But in the UK instance, it revealed some weakness in terms of the plumbing of our financial markets, namely in the pension sector. So these defined benefit schemes, which promise to pay out a certain income to retirees when they hit retirement, they've been engaging in a process of liability-driven investment. And that's where they match their assets and liabilities in duration terms. And given the gilt market is much smaller than the treasury market, for instance, they have to use leverage and derivatives, particularly through swaps with banks, and that's how they achieve this match with big balance sheets. And these volatile moves in gilts means that a lot of these leverage trades had to be unwound through the crisis. They were subject to margin calls, and that of course triggered another round of selling as people scrambled to meet these margin calls. And so you had this feedback loop, which meant that there were no buyers of gilts and caused these big spikes. And of course, the Bank of England stepped in with about 65 billion of asset purchases. That's calmed things, but the result of this volatility is that there we go. The result of this volatility is that mortgage rates have gone up, and that's what's really sealed Liz Truss's exit. Really, is that she's made things significantly worse for a lot of the population in terms of what they can afford. So just to give you an idea, 5-year mortgage rates have tripled since at the start of the year, from about 2% to about 6% currently. So plainly, that means that a lot of people just can't afford their payments, and those that can obviously will have much lower disposable income, and again, it's essentially sealed her doom. But of course, the UK is a relatively small part of the global economy. It's about 2% of the global economy in GDP terms, and really, the UK specific issues shouldn't have too much of an impact in terms of allocating to global markets. Of course, global markets dominated by the US, which is huge capital markets, and China and the US, the two big economies in GDP terms. But the key thing to ask, and what this should really stimulate you guys to be thinking about, and us as well, is no one was really talking about LDI risk in the UK market. It wasn't seen as a sensitive area by most commentators. So is there a risk of anything similar emerging in larger markets, something that's beneath the hood? And I think it's an interesting question to ask. And if you look at this next slide, the UK didn't have a particularly big debt problem relative to peers. If you look at net debt to GDP, so the UK is this orange line. You could ignore the grey box here, as that's the forecasts, and that those forecasts were done before all of this turmoil in the UK. But again, we got a net debt to GDP ratio of about 84%. The US is about 100%. So again, it's more indebted. Germany's looking fine, but also you've got Italy and Japan at 138% and 168% respectively. So again, the UK didn't look like an obvious outlier here. Of course, you shouldn't just read into these numbers. There's all sorts of factors in terms of the composition of debt. But if you look to the next slide, you can look at the deficit numbers as well. So this tells you about the direction of the national debt, and so of course, as we're building up, we've got the current account deficit figures in yellow, and the budget balance. So how much you're spending more than you're receiving in tax, and that's shown in pink. And the UK is obviously running large twin deficits at the moment, and that's something that the market is concerned about. And obviously there are doubts as well in terms of how much you can raise through austerity, and how much the kind of the political will is there to impose austerity. So these things are pretty structural. We've run a current account deficit for a long for a long period of time. But again, given the dynamics of higher rates and inflation as a problem, that this is what's concerned markets. And of course, the other one that sticks out here is the US, again running twin deficits, but again these are slightly lower. And you'd always have to be careful about making these simple comparisons, because of course the US is very different to the UK. The US is a 20 trillion plus economy with 330 million odd people. So you can embark in a kind of Reaganomics or deficit spending in the US, and you've got much more behind you. Whereas it doesn't really work so well in the UK when we're a much smaller economy, and again we don't have the benefits predominantly of having the world reserve currency, and that's the big thing for the US. Almost no matter what sort of deficits they run, there's always demand for dollar assets, particularly treasuries. China and Japan are big buyers, and they need these dollar assets to function and pay for things like oil and global trade, and that's how the economy is run these days. You know, China and Russia are kind of moving or trying to move to say a renminbi-based system, or there's talk of kind of a gold-based system coming back, but these things are long term. The way the markets are set up at the moment, you know, the US has these privileges. So if we skip to the next slide, we can see that again, looking at the US, what's the inflation situation? What's the rate situation? And you'll all be familiar with what's going on. But really, just the Fed has been very aggressive in tackling this inflation. You've had if you look at what the futures market's pricing in, there's another 275 bip rate rises expected before the end of the year, and the rates look like they're about to peak at about 5% next year. Of course, that's a moving target at the moment, but you know these are kind of Volcker era increases, right? In terms of the steepness, we're coming from a much lower base, but again, just the steepness of these increases and the fact that we're a lot higher than we were through the GFC era, and obviously the COVID era. So that rate of change is pretty significant. Of course, inflation is still well above these rates. It's 8.2%, and again, this is the key debate that's moving markets. But I think it's important to point out some of these effects of rising rates, and we are seeing some signs of cooling, and these are going to be these are what the Fed will be looking at as well. These sorts of metrics, and you know, this is having an impact on markets, and given this steep rate of change, and given some of these real impacts to the economy, we do expect inflation to come under control and move back towards targets next year. But of course, things are unusually certain at the moment. I'm not going to talk much about Ukraine, but obviously that's a big unknown in terms of what's happening to food and energy markets, and as well as what's going on in US labor markets. So this is a particularly uncertain time, and you should be wary about betting the house on one outcome over another. As I'll talk to you later, you know, diversification is the real way to combat these unknowns. But it is interesting to talk through some of the cooling effects that we're seeing. The key driver for that, again, this Goldman Sachs index is a good. It kind of shows it complements what was shown in the previous slide, and this doesn't just look at interest rates. It looks like things like credit spreads, equity valuations, dollar strength as well, I believe, and it's just showing you that the environment for credit and for these liquidity conditions, it's tightening across the board and at a steep rate that we've not really seen since the financial crisis. You know, obviously we had this tightening through COVID, but that was not very sustained. And again, this is a particularly steep increase. But the most obvious impact of higher rates is coming through in mortgages. So I mentioned the situation in the UK. The US is in a similar position. You know, it's jumped from 3% to 7% in terms of mortgage repayments, and you know that's going to have an impact on markets. You know, we don't see a full-blown property crisis like 2008. Lending has generally been much more sensible. Less of these ninja loans and so forth. But obviously this has an impact on demand. You know, when or when people refinance and they look to move and so forth, or again there's some trigger that they have to refinance their mortgage, they'll be paying a lot higher rates, and again this impacts spending. It curtails demand eventually, and you'll see this being disinflationary, all other things equal. And that also comes through on the next slide, which just looks at houses. So the housing market index in red on the left-hand side. You can see plenty of volatility coming through, but the thing that stands out is that sharp dip. And you can also see that in single-family starts, and in new house builds, and you're seeing that dip come through. And there's similar things driving that, of course. So it's if there's tighter financial conditions, less people can afford to maintain their mortgages. They can't borrow as much. Of course, that's going to have an impact on the housing sector. That's not the only disinflationary impulse we're seeing from recent changes in the macro environment. We're also seeing commodities actually looking a fair bit weaker. So again, if you look to the 6-month figure, you just see a sea of red covering a whole range of different commodities. There's headlines around natural gas at the moment in Europe. Of course, there are big concerns there with Germany's reliance on Russia. But actually, the EU has done a good job in terms of building up their gas reserves. Of course, a lot will depend on what demand will be and what sort of winter that we'll have. But at the moment, again, there's a lot of these numbers have come off a big way from the peaks, and again, part of that will be due to idiosyncratic demand and supply issues, but generally there's concerns of recession, concerns of waning demand, and just where we are in terms of the cycle is driving some of this as well. And of course, lower commodity prices feeds through to inflation, which will obviously bring inflation down. Of course, commodities aren't the only thing driving it. We're seeing core CPI still be persistently high as well. So again, this is not the be all and end all, but it's an important factor to consider. We also obviously have seen the impact that rising US rates has had on the dollar. It's not the only thing impacting the dollar. You can argue there's a bit of risk aversion in there, flight to safety. But again, the dollar's been on obviously an exceptionally strong run. This makes things cheaper for US importers, which should actually help quell US inflation. Again, all other things being equal. Of course, it creates problems for other countries that have to buy things in dollars, which are more expensive. And generally, it acts as a constraining force on global liquidity. And of course, right now, or certainly year to date, US dollar cash has been a great place to be because of this dynamic, because of increasing rates, and because of this kind of flight to safety and decline in risk assets this year. But I think despite all of the factors we've seen driving inflation this year, and all the talk we've seen of stagflation and everything else, the next slide is perhaps the most powerful, I think. This just shows long-term inflation expectations, and this is derived from breakevens, which is the difference in nominal treasury yields minus the treasury inflation protected, or your TIPS yields. So this is the implied inflation rate, or implied inflation expectations over the long term. And we've got 2 years in yellow, which are obviously a more volatile data series, and then 5 years in pink, and 10 years in light blue there. And particularly that light blue line, it's been pretty consistent. And this kind of makes sense intuitively as well. If you think that things that drive long-term inflation expectations, things like demographics, things like technological innovation, they don't change very much, month to month. And in fact, a lot of the technological innovation we saw through COVID, and the fact that we're speaking to you via Zoom now, and rather than flying over to South Africa, for instance, that is all. That eventually that helps in efficiencies and drives costs down, and shifts that supply curve in the right direction. And again, these things have effects over these sorts of 10-year time horizons. So again, this is something that's fairly encouraging, and if it is kind of close to correct, then you'd expect to see the kind of the month-to-month CPI numbers kind of falling down back towards targets over the kind of medium term. But again, we still think this is a great way to hedge the inflation risk as well. I mentioned the uncertainty that's out there. TIPS are a big part of our portfolios, and again, if this blip here that we saw If that becomes more persistent, tips will give you that sort of exposure or that sort of protection where non-rules won't do. And again, we think they're a pretty attractive part of portfolios at the moment. This slide shows our risk aversion index. It just brings together a bunch of different market indicators, just showing you what's priced into markets and how much fear there is out there. And I guess the point to make here is that we're not seeing big COVID type spikes. Typically, these spikes are big buying indicators. You want to see these big outside spikes. March 22, we had a little bit of one there that looked, again, it looked slightly outsized, but again, not quite what we saw through COVID. Generally, these are all higher, which reflects the market volatility. But again, since we're not seeing that big spike at the moment, we're not inclined to be adding risk in any meaningful way. We think that if we saw a leg down from here, I think we'd revisit that and we'd have that discussion. And we do see some value emerging, as I'll show in my last two slides. There's definitely room for optimism, but that sense of where we got to in March 2020, where things got completely bombed out, we're not there yet in terms of this risk aversion index. So one of the questions that we did get before time was on our outlook for emerging markets. So I've got 3 slides here on emerging markets, which I think provide interesting talking points. So generally, we're definitely seeing some cause for optimism, and that's when we look at policy and inflation, the inflation dynamics, particularly with again how central banks are acting as well in a lot of emerging market countries. But of course, all the talk now is of recession. And it looks like we're entering a period of slower global growth, especially in terms of what's happening in China. And the dollar is obviously going through the strong period. And typically that's a tough time cyclically for emerging markets. However, if you kind of look through that and again, you worry less about timing and kind of look more long term, many emerging markets kind of manage this crisis well. A lot of them have got floating exchange rates, so that absorbs a lot of the pain. They haven't built up big dollar liabilities. There's not big solvency issues in most emerging markets. And actually, you can argue that a lot of central banks in emerging markets have been much more responsible than in developed markets. And that creates opportunities. And again, our projections internally are generally pretty optimistic on the outlook for emerging markets in most scenarios. So this is just showing Chinese CPI in green, and Chinese rates in yellow. And it's just a reminder that China doesn't have an inflation problem. In fact, it's actually looking to stimulate given what's going on in the real estate sector. So again, cyclically, China looks like a pretty interesting place. There's obviously all sorts of geopolitical concerns, and you should be putting a high or higher risk premium on some of those. But again, you look at this slide, look at valuations in China, and it looks pretty interesting to us. Brazil is another very interesting market. Of course, there's political uncertainty in Brazil, but just look at this the Selic rate there. So that's their interest rate, and they've been absolutely brutal in terms of increasing rates to about 14%, and you can see it's absolutely crushed inflation down to kind of 7-8% there, and those sorts of real rates will undoubtedly attract capital into these sorts of markets. Generally, that should be positive, and it's got the possibility to start one of these virtuous cycles. But of course, there's other things going on in Brazil. There's a lot of their equity market is linked to what the oil is doing. So there are, of course, risks. But again, it's just an example of how the central bank has been acting prudently. But of course, emerging markets are not one homogeneous whole. They are very much heterogeneous, and Turkey is an example of what not to do, really. I don't, unless there's questions here, I mean, I don't need to talk around the causes for this, but needless to say, when inflation is running at whatever that is, 80-odd%, you probably shouldn't be easing monetary policy. So just got the last few slides now. The next two are probably the most interesting. So we look at the universe on an equally weighted basis. So these PEs that you'll see won't tally with what you see from MSCI and on the main indices, but we think they represent a good approximation of the universe that our active managers can access, because they really are unconstrained. And I mean, the key takeaway really is that it's a pretty volatile series, particularly in DM on the left, but we're well below the 5-year average now. And you know, the DM markets are obviously dominated by the US, which has looked expensive for a while. And for the first time in quite a long time now, you're seeing some pretty good valuation opportunities emerging. And that's the same in emerging markets as well. And this picture chimes with what we're hearing from our managers on the ground as well, and the guys that we're talking to. So again, it's a cause for real optimism, and you can get this discount, or you can buy into this relatively cheap series here without sacrificing quality. And this is the same universe, just looking at return on equity, which is the metric we've chosen for quality here. And you can see return on equity is actually above its 5-year average. So again, you can get the quality at a decent discount. And again, typically in times of such turmoil, you know, they're usually good times to be buying and entering into market. So whilst there is a lot of uncertainty out there, these charts should be pretty optimistic for long-term investors. So this is the macro summary. I'll conscious of time now, so I won't go through these points, but I'll just focus on the last slide now. And again, we can take questions here, but this just summarizes our view. So again, many regular listeners will kind of know our views, but if I was just to pick out one point here in the interest of time, I would just talk to our diversifiers. And we did get one question on what acts as a diversifier when your 60-40 portfolios are struggling. And you have to look in lots of different areas. So Chinese government bonds is a great example that we started. We entered at the start of the year. Again, you've got rates falling in China, so bond values have been increasing. You know, they've got the inverse effect there. You still had a bit of an impact from a weaker currency, but actually they've protected you relatively well. So that's one area. Commodities, of course, is another great area of diversification. Gold had a great Q1. Been a little bit weaker, but still it's helped protect portfolios, certainly in relative terms. And infrastructure and liquid assets are great examples there. So it's infrastructure. Obviously, you have this inflation pass through a lot of these infrastructure contracts, which is very helpful. And liquid alternatives is kind of a bucket for all sorts of different strategies. But again, we're very active, and those of you who've come to Think Tank in the past will be aware of a lot of our different strategies in this space, be it from music royalties to liquid hedge funds. There's all sorts of exciting opportunities here. So that was my final slide, and I think with that I will stop here and pass over to Andrew. So apologies, Andrew, I've run over by about 3 minutes, but hopefully that won't throw you off too much.
No problem at all. Thank you very much, Rob. Let me just bring up my slides. There we go. Hello, everyone, and thank you very much for joining us this afternoon. I am going to talk about multi-asset portfolio construction, how we think about it, and in particular talk more around that topic that Rob just alluded to in terms of how to diversify beyond 60-40 when 60-40 is not working. What are the other drivers and asset classes that you need to build into your portfolios and strategies that you can employ through this sort of period. The presentation will broadly follow these topics, as I mentioned, but kicking off with a bit of a review of 2022, which, as I put here, quite an exceptionally bad year. It's been incredibly painful across so many different asset classes, as everyone will be well aware. I think one thing that's just to kick off with that's interesting to reflect on is actually how most market participants were quite constructive at the start of this year. As we, before the Russian invasion of Ukraine, before these inflation fears became so embedded and accelerated. Actually, if you look at a widely referred to survey by Bank of America Merrill Lynch, their fund manager survey, which surveys hundreds of professional investors, that was indicating that those investors were as overweight of equities within their portfolios that they're managing, as they've pretty much ever been at record high levels in terms of response rates in the last 20, 25 years or so. And also a survey of perception of risk indicated that risks were pretty much at their lowest level in aggregate across geopolitical risk, credit risk, economic risk, etc. So quite a remarkable change of circumstances since then. And of course, that explains the pain that we've seen in markets. These charts show you the year-to-date returns on the left-hand side for the S&P 500, US equities, and on the right-hand side, US Treasuries. So the red line is the cumulative total return year-to-date, and the grey lines that you see are the path of returns for the same indices over the course of the last 50 years for the S&P 500 and the last 45 years for US Treasuries. The green line is the average of all of those. So clearly a very, very difficult year by historical standards for US equities on the left-hand side, one of the worst so far. Earlier in the year, it was the worst in history. Now it's trumped by the global financial crisis, being, I think, this one here, the most extreme, which really accelerated around this time of year back in 2008. Here we see the COVID drawdown back in 2020. But it's the US Treasuries one that really stands out as being an exceptionally bad year for government bond investors. By far the worst year so far in all of these 45 years on the record. And another study I looked at indicated that it's actually the worst year in over 2 centuries, incredibly. You just don't normally expect to see returns of minus 15, minus 20% from government bonds, as we've seen this year. It's quite remarkable. It's not unusual to have weakness in government bond markets, falling prices as yields rise during the early stages of monetary tightening, but not to this sort of scale, and usually not at the same time as risk assets are selling off to the extent that they have been. But it's explained by how much inflation has surprised to the upside and how aggressive this tightening cycle has been. In terms of, again, what's changed over the course of this year, if you look at US 2-year Treasury yields, they are up 6-fold so far this year. Quite an incredible increase there, of course, fall in price. And then moving on to similar charts here, again, looking over the last 50 years, this time for commodities and the US dollar index on the right-hand side there. Same sort of story, just in reverse in terms of commodities have had a very good year overall, albeit they've actually given up quite a bit over the course of the last few months or so, whereas the dollar has just gone from strength to strength. And this is an exceptionally strong year for the dollar, one of the strongest now on record. Interesting to note, though, the trend over time represented by this green line, that generally it's pretty much a zero-sum game. And over the very long term, on average, the dollar has been flat per annum. Commodities, you've generated a slightly positive return there, but less than we saw for the averages for government bonds and particularly for equities as well. So this is what it's meant for a typical balanced portfolio, the classic 60-40 portfolio, 60% invested in equities globally and 40% invested in bonds. One of the worst years on record, and yeah, more or less tracking around the worst in the last 50 years or so. And that comes down to the point that normally we see a negative correlation between equities and bonds. If equities are doing badly, then often bonds are doing better, or vice versa. But this year, with both down so aggressively, that's a very unusual scenario. So not a banner year for your typical multi-asset or balanced type portfolio. I'll go on to talk about how we think you can do a lot better than this and how we have done within our portfolios as well. But at the same time, it should be recognized that there have been benefits to multi-asset diversification still this year, even if you went via a naive 60-40 portfolio. I mean, at least this brings you decent sector, geographical, country diversification within there. Some other kind of more narrow single asset class, single strategy returns, just to highlight, to put this into context, would be the return on 30-year UK gilts, which clearly is an area of particular pain in the UK, but year-to-date return to the end of September was minus 45%, which is quite remarkable for what is often deemed a risk-free asset. And then growth stocks, the ARK Innovation ETF is a bit of a poster child of particularly the post-COVID growth rebound in momentum, high growth stocks managed by Cathy Wood. That has been suffering a large drawdown since around the middle of last year. But if you just look at the year-to-date return on that, it's down 60%, 60 in dollar terms. Now, of course, the power of compounding works against you to the downside. And just worth bearing in mind that to recover those sort of losses, 45% and 60% respectively, in two assets that you could very reasonably have at pretty significant weights in your portfolio, you'd have to achieve subsequent returns of 82% for the gilt and 150% for the ARK Innovation ETF from here, from that year-to-date point, in order just to break even. So incredible pain, and at least the downside in 60/40 has been somewhat lower than that. This chart highlights the problem that I mentioned in terms of equity bond correlations. Normally, they're lowly or actually negatively correlated over most periods, but that's changed more recently. This chart shows you the rolling 60-month, so 5-year correlation between equities and bonds, generally minus 0.2 to minus 0.5 or so over much of the last 20 years or so, but now positive, which it has been seen before, but not for a very long time. And this is a key problem that has been particularly acute this year. It won't stay this way necessarily. On a look-forward basis, then maybe that correlation reverts downward. But we need to think about how to manage portfolios in this sort of environment where actually the critical problem is bonds cannot be relied upon for ballast or downside protection within portfolios. So this is how we do it within portfolios at Momentum. The right-hand side represents our approach of outcomes-based investing compared to the left-hand side being a static 60/40 portfolio. And what we believe is that our outcomes-based approach, more diversified, more considered strategy selection within that, gives you a better chance of, as measured here, achieving your outcome over the long term. It doesn't necessarily mean better returns, although generally it probably will, but we measure it in terms of what is the probability of delivering on that investment objective that you have, be it cash plus 4% over a 5-year time horizon or something like that. What is the probability of achieving that over that time horizon, and also trying to minimize, as demonstrated on the bottom part here, minimize the drawdowns along the way as well, in order to help keep clients invested. If you go through those 45%, 60% type drawdowns that I was talking about in more narrow strategies, it's very easy for clients to jump ship along the way and think, this isn't working, I can't lose this much money, I need to sell. And we know that selling out at the lows is one of the key reasons why returns for your average investor aren't better than otherwise, because they don't stick with it for long enough. So if we can help reduce the volatility, reduce those drawdowns, then we think it gives investors a better chance of seeing it through to capture the long run benefits of those different risk premia that you're building into portfolios and the inefficiencies that you're hopefully harvesting within markets. So how do we do that? Simplistically, it's strategic asset allocation to begin with, and there's a lot that can be achieved there, and that's the biggest determinant of the portfolio outcome. What is your long-term mix of equities and bonds and different asset classes beyond that as well? And then these other elements that I'll talk to in terms of extending the opportunity set beyond equities and bonds. There's a world of opportunity out there in other asset classes. Takes a lot of resources and effort to tap into it effectively, but it's valuable, worth doing. And then tactical asset allocation, so varying the weightings over time to hopefully increase return, but also potentially reduce risk as well. And then the actual strategy selection within there, so the style selection and the manager or stock selection or credit selection within that. So let's build this up. So starting off, here's your typical 60/40 classical portfolio that we've been referring to. The next level from our point of view is going to multi-assets, and as I say, increasing the breadth of the asset classes being used. So assets such as property and infrastructure are key here. Alternatives, more hedge fund-like or similar type strategies, and indeed cash as well. It's not been considered a particularly useful asset class over the last 10 years, given where yields have been, but now is looking much more interesting and worthy of a slot in portfolios. Then multi-strategy within there, so think about the sub-asset classes. So for example, fixed income isn't all about government bonds. There's investment grade bonds, high yield bonds, convertible bonds, emerging market sovereigns, emerging market debt, floating rate bonds, etc. Using all those different levers in there and making it a genuinely multi-strategy construction, and changing the mix within those asset classes as well. So not having as much just in government bonds for fixed income, you take some away from there to add to those other areas. And then finally, multi-manager as well. And here, one of the key benefits that brings on the equity side of things in terms of how we construct portfolios is introducing different styles and a different style balance within portfolios across value, growth, and quality approaches. So what are the benefits of that? This is what we've modeled based on historical returns for we call it the level 1, level 2, and level 3, which depicts what I showed you before in terms of those different multi-asset, multi-strategy, and multi-manager constructs. So first line is the annualized return over the last, 10 years that we've used here. And second line is standard deviation risk, and then you can look at the risk-return ratio within there, dividing the return by the risk. So what we see is as you move to the right, increase the diversification within the strategy, the return increases fairly significantly, actually, by 1.3% per annum from 60/40 to level 3. And the risk also reduces from left to right generally as well, albeit slightly less than the return increases. But the increase in the improvement in the risk-return ratio is pretty significant here, going from 0.76 all the way up to 0.96. So a more efficient portfolio, you're getting more return for each unit of risk. Measuring risk in terms of volatility is not perfect. It's a bit of an abstract concept for a lot of clients. This is the sort of risk that most people worry about, and indeed we model for within our approach as well, drawdown risk. And now here we're looking at the difference year to date in terms of drawdowns across MXY, which is MCI World, so global equities, 60/40, and that level 3 portfolio. And you see that level 3 more diversified, multi-strategy, multi-manager portfolio has delivered a much better outcome over the course of this year. Still, challenged for sure, but it's a very, very tough environment, and there's very few places to hide for long-term investors. The only place you could have really safely protected capital this year is dollar cash. But nonetheless, this is a much, much better outcome relative to a more naive balanced portfolio, or indeed relative to equities. So one of the key ways that we think about also managing risk and improving that outcome and journey is through style blending within equities. You'll be familiar with the different manager style approaches. Some just have a blend approach, but there's a lot of differentiated high conviction and high tracking error strategies that look very different from the benchmark, that employ, broadly speaking, either a value or a growth or a quality approach. So your value managers buying usually beaten up or out of favor, unpopular, sometimes lower growth businesses, whereas your growth managers are willing to pay up for the higher growth expectations going forward and positive momentum and riding that along the way. Both strategies, as well as quality as well, we think work very well over the long term, and that's evidenced through a lot of academic research and data, but also realized manager returns as well. Here we look at the returns using the MCI World style indices, which they're not perfect, but they're a pretty good proxy for those different styles. And what you see is those 3 different styles are pretty volatile over time. They have pretty long periods of outperformance and also of underperformance. Pre-GFC was great for value, but then post-GFC has been pretty terrible. And in the post-GFC period, growth has been unstoppable, really. It's had a phenomenal run for a very long time. And quality has been pretty dependable, particularly during periods of market weakness. So you can see from here that over a 25-year period, they all end up in a good place. This is measuring cumulative excess return versus the benchmark. So each one of these, you could have chosen any one of them and stuck with them for that period, and you end up with a very good excess return versus the index. And potentially picking the best managers, the best exponents of these styles adds a little bit more as well. But what's particularly powerful here and evident with the red line is the low to negative correlation across these styles, which creates a much, much smoother journey. So you get to pretty much the same endpoint, but without the big swings in between, without this big period of value underperformance or this big period of momentum underperformance, such as after the tech bubble. So we believe this sort of approach enables you to capture all the best attributes, characteristics of active managers and style selection, but by combining them carefully, generally equally weighted, then you can achieve a much better outcome in portfolios. And that's very clear here in the drawdown experience. So green is the simple 1/3, 1/3, 1/3 blend across them. The maximum drawdown from when a drawdown starts to its trough has been much, much lower for the combination here, sub 10% pretty much at most times, whereas each of the individual styles have periods of 25, 30% plus underperformance, or in the case of value, this quite remarkable, massive underperformance over the last 25 years, which broadly started during the GFC. So style selection and style blending is a key tool that we use, a key lever that we use significantly within our portfolios. But also, as I mentioned before, choosing different asset classes as well. So these patterned lines here show you index returns. And one of the things that we benefited from within our portfolios this year is having significant allocations to global listed infrastructure, which are listed equities, but it's very sector specific. And we go there because we expect greater stability, greater inflation protection and pass through, better yield and the like as well, and less economic sensitivity. And that's really delivered very, very well so far this year for those sort of reasons. Here, you know, the disappointing returns still overall, but well ahead of general equities. But then there's also the opportunity to benefit from strategy selection as well. So we've picked, as well as broad global infrastructure managers, we've also picked some other more focused businesses as well. One of them being this Gore Street Energy Storage Fund, which is a UK listed investment trust, which provides grid scale energy storage solutions for the UK, which is a key enabler for the more widespread reliance on renewable energy in order to balance the grid and make sure power is available when and where it's required. That's held up very, very well this year, and this is to the end of September. So this also captures some of the weakness that we've seen in the course of the last month or so, driven by the carnage, frankly, in the UK market, which has had some knock-on effects to the investment trust market. But nonetheless, this holding is still held up very, very well. Similarly, within equities, value-oriented strategies have performed very, very well this year. So between Moran Wright and several of our other managers, many of them have outperformed their respective regional broad equity index by 15, 20, 25% or so this year. Huge numbers, and highlighting that there's a lot more variation beneath the surface of broad equity market returns. And then similarly within global bonds as well, it's not all about treasuries or global aggregate indices or the like. What we've done within our portfolios around a year or so ago, we added an allocation to Chinese government bonds, as represented by this dark green line here. That's held up a lot better. That's despite some significant renminbi weakness over the course of this year, which accounts for most of the negative return, because actually the bond component of the return has been very, very stable and good, reflecting the reason we went there in the first place. Positive real yields, much better than you can say for any Western market, and a lack of inflation, really, no inflation problem compared to what we're seeing in the US and Europe, etc. So the currency's gone against us this year, but longer term, we think that will be a tailwind. But also short duration credit strategies, as represented here, another area that's significantly outperformed global bonds. So a more nuanced approach within that. And then moving on, what we look at here is thinking about, well, what if we had perfect foresight, not perfect hindsight, but perfect foresight to say, like, I know exactly which asset class is going to do best over the course of the next year. So what would my portfolio return have been if I'd overweighted the best asset classes using a rules-based approach, which is explained at the bottom here. So modest overweights to the best performing asset classes, all the way down to having modest underweights to the worst performing asset classes. As you'd expect, over the course of the last 10 years, that would have generated a much, much better return. But of course, that's completely unachievable. No one can actually have that perfect foresight. But what's interesting here is it highlights the point that you're not going to get a return without risk. Because if you look here on the right-hand side, the level of risk volatility that you get with that portfolio is actually the same or marginally higher than the level 3 portfolio I talked about before. Yes, the return's better, so you've got a more efficient return overall, better risk-adjusted returns. But your risk, and indeed, as shown here, your drawdown is actually, there you go, is actually very, very similar to those other areas. So, except we're not going to eliminate risk entirely from our portfolios and manage accordingly, would be the message. Many of you will have seen similar charts to this, but it bears reminding, I think, at this point. So this is looking at the returns to investors of putting $100,000 into the S&P 500 back in 1999 and different scenarios along the way. So if you had just left that fully invested, just lock it away and don't touch it for that entire period, then you've quadrupled your money, more than quadrupled it to 432,000. If, however, you tried to market time and you were unlucky enough, you have to be very unlucky, but if you're unlucky enough to just miss the 5 very best days, then your return is half as good. And worst 10 days, you only double your money over the period. If you miss the best 20 days, then you don't make much at all. That's a pretty small return on an annualized basis over the best part of 25 years. And if you miss the best 40 days, then actually you make a loss over the period. We've got to recognize that it's very, very hard to call when those best days are going to be. Often they're the biggest rallies at the very, very start of a recovery. So there's huge risk in trying to exit the market during tough times like now, because you just don't know when the market's going to turn. Back in 2020, the worst of the COVID drawdown, remember, markets turned on March 23rd, when the whole world was pretty much shut down. There was no reopening happening anytime soon. No vaccines had been developed at that point. Still huge systemic risk and credit risk within systems, and just impossibly negative GDP growth scenarios playing out. But markets bottomed then, and returns over the subsequent months were very significant. So it's very difficult to call when those recoveries are going to begin. And this chart here shows you how well our portfolios have recovered during similar previous drawdowns. So back in 2009, the financial crisis, 2011, the European crisis, 2015, which was driven by fears around China, 2018 as well, which was a smaller drawdown driven by recession fears, and then of course COVID as well. So here we're looking at our core managed solutions, 2 of those funds, Cautious and Managed, and their subsequent net returns over the following 12, 18, and 24 months. And you can see that if you stuck with it and captured, held onto those portfolios from the lows over those subsequent periods, you get very, very strong returns overall. And a lot of that would have come in the relatively early stages of those recoveries. An important point to make, as Rob alluded to, within our portfolios, we came into this year quite conservatively positioned, actually, because we'd taken profits from the post-COVID rebound, and as valuations had increased fairly materially. So we didn't need to de-risk when this very challenging environment came along. And then also we were very patient about not increasing risk within portfolios, recognizing what a tough environment this would be and how long it would take and how much markets would need to adjust to the realities of inflation and where rates needed to get to. We think we're pretty far through that period now, but nonetheless, we still haven't made this big wholesale increase in risk. We've done more of a rifle shot approach to taking advantage of select opportunities. But it means that we're in a good, strong position now to increase risk when we think the time is right. We've got plenty of dry powder and lower risk investments that we can recycle into equity and credit and the like, which we've started to do more recently with the dislocations we see in the UK market. We've been buying into UK bonds in particular with a longer term view. But the most important point to make is that we haven't de-risked. We still are carrying the same broadly exposures within our portfolios, which are being actively managed beneath the surface by specialists from around the world. But that means that we have a huge amount of rebound potential within the portfolios as and when markets recover, which we all know they will. And I think that time is getting closer as pessimism grows. Coming back to that Bank of America survey that I mentioned at the outset, which indicated that everyone had a pretty rosy view of how 2022 was going to play out. It's very interesting to note now that it's the complete opposite. And if you look across a few of the different metrics that I've noted down here, the net overweight of professional managers to equities is now at its lowest level in 20 plus years. Also, a record 91% of those surveyed think that the US equity market earnings will be falling over the next 12 months, again, a record level. And the view is that the risks, generally speaking, across different parameters are the highest they've been since the global financial crisis. That tells you there's a lot priced into markets already, and there's a lot of room for uncertainty to work the other way round and for some positive surprises, or at least if things turn out to be less bad than feared, then there's a lot of repricing potential within markets. So from a contrarian point of view, we think it's starting to look pretty interesting. And then just finally to wrap up, sorry, I'm running over a little bit. This is an overview of the funds within our suite of South African approved strategies. So the managed solutions range, so multi-asset fund-to-fund portfolios, cautious, managed, and growth. The pie charts show you the strategic asset allocation for those portfolios, so high level and a broad guide as to the average level of risk that we're going to be carrying within portfolios. But as I've been discussing throughout, clearly we have a much more nuanced definition of how to construct those portfolios beneath the surface in terms of strategic asset allocation and the actual selection within the style diversification, sub-asset classes, etc. And then also we have two global equity funds as well, one sustainable strategy, a lower tracking error, broadly diversified systematic strategy, and a multi-manager global equity strategy, higher tracking error, and including a selection of fundamental managers from around the world. Both available with dollar price share classes, and then also we've just had approval for launch of the South African Rand denominated feeder funds as well. So look out for news on them being available very, very soon. The sustainable one, of course, as true to its name, is an Article 8 fund within the European ESG regulation, SFDR. So has ESG integration throughout the investment process. And then finally, I'll just leave it on this, being a look through to one of our managed solutions funds, the global managed medium risk strategy within the range, just to give you a picture of some of the actual holdings that we have that talk to all of the different approaches to strategy diversification that I've spoken about already. At that point, I will stop and I guess hand back to Nkosana to bring up any questions that have come in. Thanks
Thank you so much, Andrew and Rob. That was very insightful, and I'm sure everyone can attest to that. I think in the interest of time, we will answer the questions via email. So if you do have any questions, please do post them to us. You can send them to myself, then we will respond to all of those questions, because I do fear that we might run out of time. But thank you so much, gentlemen, for that insightful session. And thank you so much to everyone that joined our graveyard shift. It was very insightful. And please do send us any feedback that you have and any questions that you would like the team to answer. I will gladly send them to Rob and Andrew. And yeah, if there's nothing else, I would like to close off the session. Thanks, guys. Have a good one.
Cheers. Thanks, everyone.
Thanks, everyone. Bye.
Cheers, bye.